Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with industry veterans Michael Hartzman and Dominic Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominic Tavella and Michael Hartzman.
All right, I'm Michael Hartzman, and today is Tuesday, August 18th, I apologize, 2026. Back after a couple of weeks off, along with my partner, Dominic Tavella. How are you, Dom?
Doing well, Mike. No complaints. We're, God forbid, actually starting to look at the end of summer, and we got the holiday weekend not too far away, but right now it's all good and no complaints.
Good, I'm happy to hear that. Yeah, Labor Day is a little late this year, but I feel like we're kind of a little bit in the summer doldrums. I know the market, hit some new record highs a few weeks ago. The last week was kind of a typical August summer week. The S&P was up fractionally, less than 0.5%. The Dow was down about 0.5%, and the Nasdaq was up even less, 16 basis points. Year to date, the markets are still pretty strong. The S&P is up 14.5. The Dow is up almost 13, and the Nasdaq is up about 15.5%, and that's through this past Thursday, August 14th. So I guess right now the market is what you would expect it to be, just kind of plodding along, trying to get through summer without too much volatility, and overall still pretty solid numbers for the market overall.
I think most of us, if you would have told us on January 1st, these would be the year-end numbers, we would sign up for that in a heartbeat, right, Mike? Now, we did have a little volatility 3-4 weeks ago, and that was more market internals. But the economic data, corporate earnings have all been pretty good, justifying prices, stock prices being where they are, more or less. And you have on a stock level some volatility because their earnings came out a little bit better or came out a little bit worse. But the overall economic cycle is pretty solid, and the markets are reflecting that. So for us, good news, but still cautiously optimistic.
Yeah, and I think we have to be somewhat cautious because, let me ask you this. Is the 30-year Treasury, which through Friday was trading at 5.19, and the 10-year Treasury was trading at 4.65, and the 30-year fixed mortgage, Dom, was at 6.78, which is pretty high. Is the bond market trying to tell us something? Is the bond market the canary in the coal mine?
Wow, Mike, that's a great question because in this environment, interest rates should not be going up. I know there's definitely some inflation issues, concerns, but we got a pretty good inflation number. Not great, but a pretty decent inflation number last week. It just showed that inflation, at least for now, is kind of topped out and maybe actually beginning the early stages of rolling over. Interest rates should not be this high, but obviously the fear of what's going on in the Middle East and potentially much higher oil prices and kind of maybe a global demand problem where investors are going, I kind of had my fill of bonds and maybe I want to look elsewhere. But the bond market is definitively flashing some kind of warning. Whether it's serious or not, it's too early to tell, but definitely flashing.
And you and I have said it all along, and I think we're still in agreement. The high price of oil and gasoline kind of serves as an artificial tax hike, an artificial interest rate hike, because gas costs more. Therefore, the average consumer has less in their pocket every month. So I still don't think we're going to get an interest rate hike this year to fight inflation, because I think, paying more at the pump might do enough to put, no pun intended, to put a little bit of the brakes on the economy.
Yeah, and Mike, to your point, we've had a lot of discussion, both ourselves and on this podcast, but also with our own advisors and with our own clients. Is the Fed going to raise interest rates? They're not going to, and everybody's kind of worried. Oh my God, they might raise interest rates a quarter of a percent. But if you look at what the 10-year Treasury yield has gone up, or the 30-year that you mentioned, we already got an interest rate hike. It's built in. The market has already done it. And the net effect is higher interest rates on mortgages, maybe higher interest rates on car loans, things like that. So whether the Federal Reserve or not chooses to raise interest rates, almost at this point in the game to me is irrelevant. We already got it. We already
Yeah.
have an interest rate hike.
And to your point, on New Year's Eve, 2025, the 2-year Treasury was 3.47, and now it's 4.19. That's a big jump.
Big jump. In
The,
interest rate terms, that's a huge. Now, we're not talking about the stock market, right? We're talking about the bond market.
right,
That is a huge jump, Mike.
right. The 10-year went from 4.18 to 4.65. That's more than a half a percent, or right around. And the 30-year, which I mentioned earlier, went from 4.84 to 5.19. And even the 30-year mortgage, which you mentioned, last December, it was 6.25. Now, if you're a homeowner, you're going to pay more than 50 basis points more, a half a point more for a mortgage over 30 years, Dom. That adds up.
And Mike, let me underline three times your point. And the Federal Reserve hasn't done anything, right? They've been on pause since January 1st. So this is the market saying, hey, we might want to get paid more in terms of interest because, and the because we think is higher inflationary concerns, but also there's a lot of money out there in terms of companies, governments refinancing existing debt. And the more demand there is for that money, the higher they're going to have to pay in terms of interest to get it.
Switching back to the stock market, I heard what you said. We're still cautiously optimistic, and we are cautiously optimistic. But still, again, we sound like broken records. It's all about AI. It's still all about AI, and it's all about where is that money coming from, number one, and how is that money being spent, number two.
On the glass half full, all about AI, companies are really figuring out how to use AI to make themselves more efficient and therefore being able to improve profit. So that's the glass half full side. The glass half empty is that a lot of money is being spent. We now are using the word trillions. Mike, my favorite word used to be billions. Now it's trillions. And is that money being wisely spent? Are these companies going to be able to spend these dollars and actually make a return on their investments? That's the $1 million question. So AI dominates the headlines and I think dominates the economy for the foreseeable future.
Absolutely. I mean, it's heavily weighted in the venture capital space. Technology represents 47% of the S&P 500 right now, in a non-equally weighted, right? So there are 11 sectors in the S&P 500. Technology, Dominic, provides almost 50% of the weight, according to JP Morgan.
So again, I'm going to say good news, bad news. I'll let you kind of fill in the blank, but the technology that's dominating today is not the technology companies that were dominating yesterday. So literally yesterday was all about the Mag 7. And we've talked about this at length, right? But if you just held on to the Mag 7, you didn't do anything, you just held on to it all year long, you have an S&P that's up plus or minus 14, 15%. The Mag 7 is up 3.49. 3.49, Mike. On the other hand, the microchip companies, the NVIDIAs of the world, these companies are up 20, 30, 50%. So there is a rotation of what and which technology companies are working versus which are not. But yeah, technology still drives the bus in terms of earnings and in terms of market weighting. You're absolutely correct.
And the other point I want to make with that is data centers have been in the news quite a bit lately, not for a good reason, because of the amount of electricity and water that they use, and who's going to pay for that, and is it going to affect the citizens in these backyards where data centers are built. But what's interesting, Dominic, is industrials are the third leading sector behind energy and technology this year, up 21%. And I think a part of that, and tell me if you disagree, is these data centers are going to get built. These
They're
companies
getting
are
built, Mike.
the
You're absolutely correct.
so there's going to be a lot of shovels in the ground, a lot of Caterpillar equipment all over the place building these buildings. And I think, as I can, tell me if you disagree, why the industrial sector has been really doing as well, really just as almost as well as technology.
Uh, Look, Mike, and we do try to be as neutral from a political argument as we can be. But let's be honest, the CHIPS Act, which again stuffed trillions of dollars into the tech sector, there are plants being built all over this country so that we can produce computer chips internally instead of importing them from across the pond or across the Pacific. And then throw in the data center construction so that these massive buildings can produce the AI software, make it work, and throw in the energy sector that needs to power all this. Construction on is just over the top. So you're absolutely right. And again, not something that likely is going to stop anytime soon, Mike. So when we talk about how we're relatively speaking positive in the economy, you have trillions of dollars being funneled into these areas that literally create jobs and create economic activity.
Yeah, and don't forget one of my other favorites, which never gets mentioned, is the last mile depots that get built. How else are you going to get paper towel an hour and a half after you order it on Amazon? They have these giant facilities. They call them last mile facilities. There's one in my neighborhood on the Long Island Expressway in Syosset. These things are popping up all over the country as well.
Yeah, so kind of putting a bow on it, Mike, and you're like, well, it doesn't look like the economy is doing all that great. No, if you actually get into the weeds with this stuff, there are aspects of the economy that are just on fire.
Mm-hmm.
Residential home, not so much, but industrial construction, over the top, over the
Mm-hmm.
top.
So switching gears, let's talk about our show tonight. A lot of folks are dropping their kids off for college, either as freshmen or continuing their college careers. So tonight, Dom, we're going to revisit a favorite topic of ours, education savings and the role of 529s. And in order to do that, we've gotten Greg Storetta, Executive Director, Educational Savings Relationship Manager and Investment Specialist at JP Morgan.
I'm glad I let you say all that.
Yeah, it was a little bit of a mouthful. But
I'm just going to say Greg, if that's okay
well,
with you.
exactly. I'm sure he won't mind. We just call him Greg. But he's earned the role, he's earned the title, so we had to give him that honorarium. But we'll be right back with Greg Storita to talk about 529s and education savings in general.
You are listening to the Lebenthal Report. If you have any questions or comments, please send an email to contact@lebenthal.com. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner Dominic Tavella on the Lebenthal Report. Our guest this evening is Greg Starita from JP Morgan Asset Management. He's the Executive Director of Educational Savings, a Relationship Manager, and Investment Specialist. Good evening, Greg. How are you?
Hey, Michael. Hey, Dominic. How are you guys?
Greg, how are you?
I'm doing great, thanks.
So, Greg, let's just start the conversation, at 50,000 feet in the air. When Dom and I talk to clients who have young children or try to help them, get their feet firmly on the ground, sometimes savings for college just seems really discouraging. The idea of having to accumulate 300,000 to 500,000 a kid in 18 years seems almost impossible, especially to a young couple, even when grandparents help out. And the advice that we give is we don't expect you to get to $300,000 or $500,000 to save to pay for all of college, but whatever you accumulate now is less debt you might have to incur or your child might have to incur later. But to me, I think the biggest challenge recently is just to get parents started because the whole thing just seems really daunting to them.
I totally agree. And there's so many times where I'm having conversations with advisors like yourself and clients or even friends and family where the conversation kind of veers that way. And the reality is that, some people, when they see those numbers for the first time, because I think, people know that college is expensive, but they don't know what the numbers actually are until somebody like yourself, tells them, hey, we need to get thinking about this. But the reality is that the biggest thing that we recommend to people is to just make that first step, get off the sidelines and, make that first investment. I was with an advisor in Long Island a couple months ago, and they had children and they weren't saving yet. And, you saw that panic even in their eyes. I'm like, just make that first investment, set yourself up with an automatic investment. When it's tax season, bonus season, whenever you could squirrel away a couple extra dollars, make sure you're doing it. But the automatic investment, I feel like, is the most important thing because it really helps you kind of build that discipline and that you're not even thinking about it. That's the kind of strategy that I kind of go with myself personally. I have a daughter who's a sophomore going to be a sophomore in a couple of weeks in high school. And, every chance I get, I put a little bit extra away. But I think your point in the beginning was so important. There's nothing in the parent handbook that says you must pay for $400,000 worth of education. We're all doing the best that we could. We all have a lot of expenses between mortgages and maybe private school now, and could be long-term care. There's all these other things that we're paying for. And the fact of the matter is that college is one that you could take a loan out for if you need to. So, when you're kind of thinking about all those things you're socking away for, including especially retirement and with the uncertainty with Social Security included in that, like make sure you're prioritizing these things accordingly.
And Greg, I'm glad you mentioned the automatic. And so for people who don't know what it is, I'm picking a round number, $100 comes out of your checking account, it automatically goes into the account on behalf of your child or grandchild. That is so important because when you figure out, oh, I'll get around to it, I'll write the check, it just never happens. Life interferes. So if you can set up even a minimal dollar amount and have it go automatically into that investment bucket, it can have huge returns over the long run.
Absolutely. I think, getting that power of compounding started, whether it's just starting out with a small sum and doing the automatic investments, or if you have the means to do, a larger sum, you're able to accelerate gifts up to 5 years nowadays, but just making sure you're getting compounding on your side. Because in the case of college tuition, compounding is not on your side. College tuition has gone up on average 5.5% annually since 1983. So we think about a lot of our traditional inflation benchmarks. We think about healthcare, we think about housing, we think about gasoline. College tuition is up multiples of those things in some cases. So it's in a lot of ways, the silent one that people aren't necessarily thinking about, because all we're thinking about is how much it costs to fill up our car at the pump or how expensive housing has gotten. This has gone up so much more, and it's something that there's no necessarily end in sight with it either. So it's something that we need to make sure that we're planning for. And hats off to you guys for having this platform for your clients to help educate them and help them make these right decisions, because the more that they kind of get ahead of this stuff, the easier and hopefully the better the outcome is going to be in the long run, especially when you have something with an 18-year time horizon like you do with college.
And another, thank you for that, by the way. And another misconception that Dom and I always try to clear up, we hear frequently, well, I don't want to do a 529 because if I don't use it for college, we're going to lose the money. So could you clear that one up as well?
Absolutely. So you're not going to lose the money. It's your money at the end of the day. There are a lot of options. So the reality is, if the child decides that they're not going to go to college, if they decide that they want to go into one of the trades, for example, trade schools and apprenticeship programs are included, as qualified withdrawals. You can also use it for supplies as well. So if they decide they're going to become an electrician, they need to buy tools, you can use it for that as well. Obviously, in a situation like that where you're planning for college and then they go to trade school, there will be potentially excess money, but there's a lot of off ramps with that. So you have things like the new Roth IRA option, which rolled out a couple of years ago, and we're starting to see a lot more traction with it. So you can do up to $7,500 per year currently, up to $35,000 total over the course of that 5-year period. And what that does is, now not only are you giving the child a potential gift of an education, now you're giving them a retirement nest egg as well. And you guys know better than anybody, the fact that it's a Roth makes it so much more valuable because they're not going to pay taxes on the back end. So in the case of a child in their early 20s where they're getting that Roth IRA off the ground at that point, they're getting 30, 40 years of compounding interest on top of that and appreciation that they're not going to pay taxes on the back end. So it's a home run from my standpoint, because it's the most common rebuttal that we get. I'm afraid I'm going to overfund. The reality is that most people are so far underfunded, but there are occasions where people are. But let's say you exhaust the Roth IRA option. There are other ones as well. You could change the beneficiary. So if child 1 doesn't use all the money, you could change the beneficiary to child 2. Now they'll have some extra. You can make yourself the beneficiary. So if you wanted to go to culinary school or golf school, the common ones that get thrown out there, as long as it's an accredited school, you can use it for that as well. And at the end of the day, you could take the money out. It is your money. It'll be treated like a taxable account. You'll pay taxes on the gains, and then you'll pay a 10% penalty on the gains as well. So it's one of those things where there's a lot of common misconceptions around, I'm going to lose the money, or, the penalty is so egregious. Listen, over the course of an 18, 22, 25-year investment, hopefully you have a lot of paper gains on that portfolio. So if you're getting taxed and paying a penalty on those gains, it's still found money the way I kind of look at it. So it's not the end of the world, but there are plenty of options to exhaust before you get to that point.
Dom, I know you have a question for Greg, but I can't let what he just said just go past without me commenting. A parent or a grandparent could take that money back and use it for golf school?
Correct. So I know you guys are golfers. So if you wanted to, you could look at that as an option as well. Again, as long as it's an accredited school, you can use it for those purposes. Well, make yourself the account owner and the beneficiary. It's an easy change of beneficiary form, and then you have access.
Yeah, you want to do that cooking school in Italy? You just found a way to pay for it.
There you go. I could use the golf lessons myself. I'm just starting out after all these years, and it's looking pretty ugly so far.
But Greg, and we obviously can tease a little bit. And I have a couple of these clients that over the years, for whatever reason, they did not use the entirety of the 529 plan. And I'll get a little kickback for the first minute and a half. And I go, and this is a real problem. This is that we have too much money in the bucket left over, that your kid was able to get through college and we didn't spend every dollar, or your kid chose a trade school and we didn't spend it. This is a problem, that we have too much money. And you know what? When you spend a minute of common sense, they're like, no, it's not a problem. We'll find what the alternates that you spoke about, and hopefully we'll bring up a few more. But having too much money in the education bucket is not a problem.
And there's no time limit and there's no required minimum distributions on it too. So it could be generational too. So if there is money left over in your child's account, you'd be paying for your grandchildren's account. You could just let that money ride over the course of, that next 20 something year, 30 something year period. And hopefully you're leaving them with a nice amount towards that college education as well.
And you mentioned the Roth as an off ramp, and let's just be clear: there are only two investments in this country which truly grow tax free, in addition to municipal bonds. But you got to pay even capital gains on municipal bonds. Only Roth IRAs and 529s allow the shareholder to grow those monies tax free. And using the Roth option, we do get that inquiry. We've set a couple of them up in the last few years. Does the beneficiary or the owner of the Roth, this 21-year-old hypothetically, do they need earned income in order to qualify for that option?
Yes. So you need to earn up to the contribution amount that they're going to put in. So if the child makes more than the 7,500 allotted for the year, you could do the 7,500. If they only make 5,000, you could contribute only up to 5,000. But that's a great question, one that comes up all the time. I think it's really important that they've kind of rolled this option out because, like I said, it's the question that we get all the time. I'm afraid I'm going to oversave, and now that there's a really suitable, option for people on the back end, and hopefully the government continues to increase those limits this way. Over the course of time, you do more than 35,000 and really see the growth behind it.
I mean, that 35,000 is a great number, but yeah, it'd be nice if they indexed it, right? Or increased it to 50,000 at some point. But I already have a few of these in the pipeline. It's a wonderful gift that you can give your children, your grandchildren for their future. If we can't use the 529 money, we're just going to convert it and make it grow even more over a longer timeline.
And Dominic, one of the great things about it too, that's kind of unique, is the fact that there's no income limit with it too. So if you go to open up a Roth IRA for a client and they're making too much money, you're not going to be able to. If you're doing the conversion from a 529, even if that student graduates from school and they're knocking it out of the park, let's say they're making $300,000 the first year out of school, they normally wouldn't be able to qualify. By doing the conversion here, they're now eligible for that Roth. So now they have a substantial income, and they're also growing this tax-free nest egg on the back end as well.
Greg, when Dom and I first started having children in the early 90s and mid 90s, 529s either didn't exist or they weren't that popular. So we set up an UGMA account. We switched to 529s for our children. And to me, my oldest daughter, literally started Hofstra University the first week of the financial crisis, right? So as a financial advisor, we were being bombarded with bad news. Account values were going down. Looked like the apocalypse was upon us. Hofstra University did not care. They wanted their tuition money, and I bring this up because one of the appeals to me was the target dated glide path that you could put your child on to make sure that money was available when you needed it. And and I'm living proof because I also have a younger son. My younger son's account got clobbered, but I didn't need his money for 5 years. And by the time he was ready for college, he actually had more money than my daughter did when she started. So my question to you is are those target dated funds, age weighted funds they're called, is that still where the bulk of the money is going, or have younger investors now picked a different way to invest these assets?
The majority do go into the target date funds, and your situation with your daughter, that's obviously the worst case scenario, and that's the reason why those are in existence today. It's because they'll help bring the portfolio risk down as you get closer to college age. And with that, you have obviously more fixed income exposure, so hopefully it's kind of negating some of that volatility along the way. But there are other options too. So if somebody's a bit more risk averse, they could do something like more of a static risk-based portfolio. So you could do an aggressive, a moderate, or a growth. A growth, moderate, or conservative. And it just remains static. It doesn't make any changes over the course of time. And the onus would be on you to make it more conservative if you felt the need to. We're also individual portfolios too. So in the event that you have a situation where you want to create your own portfolio, or you want to go all in on one or two strategies, you have that option too. So it really is at the discretion of the shareholder and their financial advisor to make the right investment choice for them.
Greg, if you don't mind, I'm actually going to ask you to elaborate a little bit more on that, because it's one of the objections I get. Oh, I don't want the money just sitting there. What can I do with it? So maybe just do a quick outline of the investment choices that are kind of available, both in your program, but universally.
Yeah, so like I said, the biggest one are the target date ones. So they'll either be age-based, so it's going to be based on the child's age, or it's going to be based on the year that they start college. Different programs kind of go different ways, but really the meaning is the same behind both of them. As I mentioned, it's going to be start off very, very aggressive as the child's a newborn, and then over the course of time, it's going to glide down and become more conservative over the course of time. With our portfolios, we always kind of leave a little bit of extra buffer at the end because you still need that appreciation even at college age. So while it's not going to be high octane, we'll still leave a little bit in equities. This way, you're still beating that tuition inflation benchmark, hopefully, as well. And then,
but if you wanted a growth fund, you could pick it. If you wanted a bond fund, an international fund, I mean, you literally have an entire menu of investment choices if the owner wants to make those kinds of choices.
Absolutely. So, like for our JP Morgan plans, for example, a lot of our flagship funds that are available in a mutual fund or ETF format are also available within our 529. So if somebody loves our large cap growth fund, for example, they could go into our large cap growth fund within the 529 as well. It's just in a different wrapper, basically.
So Greg, why don't we take a break right there? And when we come back, I want to talk to you about grandparents and their role in helping send a kid through college and what their options are, among some other questions that we still have lined up for you. So why don't we take a break right now, and we'll be back shortly with Greg Sarita from JP Morgan Asset Management.
You are listening to the Lebenthal Report. If you have any questions or comments, please send an email to contact@lebenthal.com. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner Dominic Tavella, and our guest this evening, Greg Starita from JP Morgan Asset Management, Executive Director, talking about all things related to education planning and 529s. Greg, let me ask you this. One kind of neat little tool that I think goes under discussed, and I don't even honestly know if many financial advisors know about it. When it comes to 529s, and it's not just for grandparents, but let's face it, it's the grandparents, the ones with the vested interest and a few more zeros in their brokerage accounts these days. They can actually take 5 years of gifting and roll it into the first year or in 1 year. So one grandparent could effectively give a $95,000 gift, and a couple can give $190,000 in 1 year to every grandchild they have. And that does two things. One, it jumpstarts that education plan, and it also helps the grandparents lower their estate. Is that correct?
That's absolutely correct. And like you said, it's available to anybody to do the 5-year accelerated gift. We're seeing a lot of traction with grandparents specifically. And it's just such a great option too, for another reason. The fact that any contribution from non-parents, so grandparents, aunt, uncle, whoever the case may be, doesn't count towards the FAFSA either. So when the student's filling out the financial aid form when they're a senior in high school, it doesn't count as an asset if it's held in the grandparent's name or the aunt and uncle's name. So now you're not only providing the kid with the benefit of an education, but now potentially more aid in the process too, because it's being held by the grandparents or aunt and uncle or whoever the case may be, which is a great option. It's very personal for me too. When my daughter was born 14 plus years ago now, I went to my JP Morgan advisor and we opened up 529. And, when I told my mom about it the following weekend, she didn't know what a 529 was. She, when I went to school, she paid cash for it, and took out some loans or whatever, but that's how it was. She loved the idea. So she ended up opening up an account for my daughter, my niece, and my nephew, did a lump sum into it, not unfortunately the 190,000, but she put a lump sum in. But then she was still working on time. She was doing a systematic investment, as we talked about earlier. So she was putting that money in systematically every single month. And then for the holidays or birthdays or whatever the case would be, she would say to me, oh, by the way, I put another $100 into Brooke's 529 account or whatever the case may be. So she always gave them a gift because, you don't want to be that grandmother or grandfather who doesn't provide a gift other than the monetary one to the child at that age. But the reality is that has become a material amount, and that in conjunction with my account that I opened up, is going to, if it doesn't pay the full freight, it's going to put a pretty nice dent in the overall cost. So I'm really, really passionate about having grandparents, aunts, and uncles, help participate in that as well where they could.
Look, Mike brought it up, and maybe a lot of other financial advisors don't talk about it, but we certainly do. And I have to say, Mike, I think you would agree the largest group that contribute to 529s is not the parents. They're trying to pay the bills. They're trying to pay the mortgages. They're trying to make the car payment. It's the grandparents, and they are doing maybe not, again, $100,000 kind of wacko numbers, but hey, why don't we distribute a little bit from your IRA on an annual basis? And if you don't need that cash flow, we can drop it in the 529 plan, right? So we're seeing a lot of this transitioning from old assets where the grandparent doesn't really need all of it and doesn't foresee needing all of it, maybe draining down a retirement account that's grown substantially well. Why don't we use that money towards funding your grandchildren's education? And the grandparents love the idea. Nothing more than you can do than if it benefits my grandchildren.
Absolutely. And one thing I've spoke to my dad about too is, he's taking an RMD for the first time in his IRA account too. He lives in South Carolina where there's very healthy deduction for it too. Said, you could take that deduction, make the withdrawal, pay the taxes, and then distribute that money to your grandchildren in the form of 529, and now you're going to get a tax deduction on top of it too. So there's a lot of different ways to kind of play it as well. That's really beneficial. But Michael, to your point earlier about the taxable estate, I think that's such an underutilized component too. We deal with it a lot. Especially when we're dealing with like private bank clients, where it's like we're looking at generational money here. And a lot of times, especially towards the end of the year, they'll say, hey, I need to get X millions of dollars out of my estate. And they have 20 grandchildren. And they'll open up an account for each one of those grandchildren, max them out with the 190, and then, $4 million out of the taxable estate in one shot. So it's a great and very much underutilized tool at their disposal.
Tom, did you hear that? 20 grandchildren. I think that's your goal.
That's my sole reason for having more. The more they give us, the more grateful I am, because I can lower my taxable estate, Mike.
Yeah.
There you go.
Listen, we are using a little humor, but let's not forget, if you're over 65, I think is the age, you just got an additional 6,000 tax break this last tax year. Married couple has 12,000 for being over 65. Is that the right age, Mike? They got the extra tax deduction?
I believe so.
So again, that's $12,000 theoretically you can take out of an IRA account. You got the tax cut from the last Trump tax cut that he implemented last year. And that's $12,000 that you can literally transfer tax-free to your grandchildren for their future. So there's lots of terrific tax planning where it benefits the grandchild, but it also is a big win for you as well.
Absolutely.
Greg, you mentioned in passing the FAFSA form, which is the government financial aid form. And another misnomer, I believe, is a lot of clients will say to me, well, I don't want to start a 529 because I heard I'll never get financial aid if I have money in a 529. So could you speak to that misnomer and clear up some of the mystery around that as well?
Absolutely. So the reality is that the bar is pretty low when it comes to maxing out on financial aid. So if you earn more than $250,000 per year and you have more than $300,000 worth of assets, excluding your primary residence and your retirement accounts, you're basically off the chart, and the government deems you capable of paying full freight for government. So you're generally not going to see much in terms of aid, if anything. So with that being said, the 529, if the client's already hitting those bogeys, it's going to be a moot point. Even if they are within that table and make less and have less than those standards, the asset bucket for the parent only accounts for about 5.64%. So it's a relatively small amount in the grand scheme of things. Really, the biggest contributor and driver of the equation is income by the parents. So if they're making a lot of money, even if they don't have a ton in assets, the reality is it's going to have a much bigger impact than having some money in the 529 account.
So the takeaway
But if it's
is
in a grandparent's name, doesn't count at all.
Doesn't count at all. So while I'm not saying people should move their accounts necessarily, the grandparent-owned account is a home run, because now, again, you have the parents who have hopefully their account, and the grandparents with their account, and the child is reaping the benefits of it.
So the takeaway is don't cut your nose to spite your face and not start a 529 because you expect to get financial aid 18 years from now.
I would agree with that. Just my opinion.
I think a valid one, Greg.
Yeah.
So can't help putting you on the spot, Greg. All the rage. Everybody's going to retire multimillionaire. Sarcasm. Trump accounts. Tell me what the story is. What's going on?
Well, there's a lot going on with the Trump accounts, and I think we're starting to see. We've been hearing about it for a bit now, but now we're starting to see it kind of take form. We get a lot of questions about the differences between them and a 529. Is it replacing the 529? I think it's a nice complement to the 529. The reality is the tax treatment is different. So rather than it being tax-free like 529 used for qualified purchases, the Trump account, there aren't tax implications on the gains when you sell the underlying securities. And if it gets rolled into an IRA, it's more of a traditional than a Roth. But the reality is that if you have a child born within that time period, it's a home run. Like 100% open up the account, take the money. A lot of employers are now doing matches. You have foundations like the Dell Foundation, the Dalios as well, who are making additional contributions to people in the event that, they're, I think a lot of times it's the zip code that you live in. If you make under the average income is less than a certain threshold, they'll give you like $250 perhaps. And you're also able to make contributions to it. Again, the contributions is a relatively smaller amount. The 529, as Mike started with, 19,000 for an individual, 38,000 as a couple, and you could do the 5-year accelerated. Here, the max you could do is 5,000. Interesting little caveat that came up a couple of weeks ago is that they're going to allow employer plans. If you're doing a payroll deduction, you'll be able to take out potentially up to half of the 5,000 tax-free or pre-tax, I should say. So if that all kind of comes into focus, that's obviously going to be a great opportunity also. Again, like it's for the benefit of the child in the long term. More to your point about just building wealth rather than a specific financial goal. It's not for college. It's not for purchasing a home or retirement. This is more like, secondary money. But the reality is it's a great opportunity to kind of get the child invested. And, one thing I do, not necessarily with the Trump account, but with my taxable accounts is I talk to my child about it too. She's 14 years old. She's still, I'm trying to get her appreciate money more than she does, but like trying to help her understand the benefits of investing. I think that's going to be, a secret benefit of these accounts too. Getting kids interested in investing, seeing the long-term benefits of it, and rather than my daughter going to Sephora and buying something that she doesn't necessarily need, take that $40 in her taxable account and put it in a fund or an ETF or something like that. And hopefully it's going to help educate them about the value of money over the course of the long run and build better practices for these children.
Greg, I think you're right. I agree with everything you said. I have a daughter and 3 granddaughters. She's still going to Sephora. She's just taking your $40.
She takes my $40 every single time, but maybe I'll split the difference with her. I'll keep 20. I'll put 20 into her account if I could kind of get her over that hump.
There you
We'll
go.
see. I'll keep you posted.
There you go. Greg, let me
I
ask you
think,
this.
Greg, maybe just to put a bow on it, but hey, it's free money. Take it, right? Set your kid up
Absolutely.
for it. God bless. If employer is willing to add to it, great. But this should not be a replacement for a 529. It should be a complement to it.
I 100% agree with you there.
Greg, let me ask you this. We started out the show talking about the high cost of college. And you talked about how, from an inflation point of view, it's off the charts. Do you ever see a world where there's pushback, where parents say, you know what, I don't need to, he'll be fine, she'll be fine. I don't need to spend $600,000 or, you have a 14-year-old. So what's that number in your head? Is there a world where parents start to say, this has got to stop at some point, that colleges have to be reined in, and the only way we do that is we send them to a state school and call it a day?
Well, one thing that we're seeing more of is people doing community colleges for 2 years, and then they'll do a private school or a state school for the next 2 years, just kind of like temper that cost a little bit. Because as you mentioned, it's pretty crazy out there. There are now 16 schools that eclipsed $100,000 per year. And some of them, you would know right off the top of your head. It's going to be Duke is number 2. You have University of Chicago, number 3, and University of Southern California is number 4. But interestingly, Harvey Mudd is actually number 1 at nearly $105,000 per year. So these numbers are obviously, to your point, just spiraling out of control. And there's a lot of reasons for it. I think a big part of that is the fact that a lot of these states and local governments pulled back funding, especially during the financial crisis and then during COVID again. So they're seeing less money coming in. And let's face facts, these colleges are a business. If they're making less money, they're going to find a way. And the only way that they have to do that is to pass it along to the end user. They're spending money on a lot of different things. They're all trying to be as competitive as possible. They want to make sure that they're getting the best and the brightest, and they're getting people who are going to pay as much as possible. So they want top-notch campuses, athletic facilities, beautiful dorms, libraries, etc. And I think one of the biggest things too is the fact that they've expanded these offerings so much. So I went to St. John's and I graduated in 2001. And when I was there in the business school, you wanted a degree, it was economics, management, finance, accounting, pick one. Now you go to these schools, the average school has 200 majors out there. So it's just like a lot of options, a lot of it where it's probably being underutilized as well. But regardless, they have to pay for this stuff. So to roll out a new major, there's departments that are built out, and they have to be staffed, and they have to have buildings and everything else that kind of go along with it. It's all just being passed along. So to your point, we could see someday where people push back. We're just not at that point yet. Who knows though? With this new AI generation, I think we need to see how this kind of plays out a little bit, because it could be opportunity where the job force sees kind of a paradigm shifts here, and maybe college is something that gets affected in that way. Time will tell.
And Greg, a point I kind of emphasize with my clients as the grandparent, you're ultimately going to get a vote, meaning it's time to write the check for the tuition. It's time to write the check for whatever the child wants to do, but you have to go, yeah, I'll send you the 10 grand or 25,000, right? Or you get to go, oh, maybe we need to rethink that strategy. I think the fact that I want to emphasize parent, grandparent is the owner. It doesn't give free rights to the child to do whatever they want with that money. I think that's powerful.
Correct. And the account owner, it's not like an UTMA or an UGMA account where at a certain age, the child gets access. The account owner in the 529 maintains access throughout the life of the account, to your point. So they do have a say in it. I think a big thing that we kind of talk about here as well is like making sure you're getting the value for your dollar too. So there's certain degrees that you could get out there that you don't need to go and spend $104,000 for a Duke for it. If you want to become a school teacher, for example, if you have a degree from Duke or Harvard or a local community college, it's the same opportunity. It's not necessarily going to give you this giant leg up like it would in finance or engineering or something like that. So I think a lot of times people just need to kind of think about and weigh, the value of the degree and like what the potential earning capacity is, and help make decisions. It shouldn't be the decision maker, but make sure that you're factoring it into the decision process for sure.
So, Greg, we have about 2 minutes to go before we have to sign off. Is there anything that either we neglected to mention in the interest of time, or anything, any last words of wisdom you would give our clients and listeners?
I think we covered a lot today. I think the biggest thing, and I mentioned it earlier, is just make sure that you're not only saving but investing. We see too many people think that they're doing the right thing because they're saving. The money is sitting in a bank account someplace, and how much is a money market yielding today? If you're lucky, 3.75%, maybe 4%. If you're kind of going like high yieldish, but the reality is that even that, it's not keeping up with that inflation. So we need to make sure that our clients are all out there. They're not just saving, but investing, because you need to beat that hurdle. You need to get the power of compounding on your side. So I would just encourage your clients to have the conversation with you. An important thing too, I was just talking about, thinking about how the degree, picking a degree and picking the school accordingly. There are net cost calculators. So if you Google net cost calculator and put in the school's name, it will prompt you to a site, and you can put in the age of the child, and it will give you a ballpark. So let's say you have a legacy, and like my boss, for example, her father went to Fordham, her brother went to Fordham, she went to Fordham, her son went to Fordham. Let's say you want to know how much Fordham's going to be. You put it Google net cost calculator Fordham, and it will tell you based on your year how much you could expect to pay based on tuition and other factors that they say. So know your number. It's a very important thing. This way you're not oversaving, you're not undersaving. The other part too is get a sense of what you're looking at in terms of financial aid as well. Like, know that if you're making $600,000 per year and you have $2 million in assets, you're probably not going to get much, if anything, from a financial aid perspective. So make sure you're planning accordingly. If you're on the lower end of that spectrum, I wouldn't say undersave as a result, but save what you could to make sure that you're going to have the best outcome possible.
Dom, you want the last word before we sign off?
You already brought it up, Greg, so I'm going to emphasize and have that conversation with your child. You'd be amazed once you give them the numbers, you show the real cost, you show the savings. They'll have a lot of common sense in themselves in what course of action they should take. So you already brought it up, Greg. Have that conversation honestly with your child. You might be pleasantly surprised at the outcome.
I agree.
So on that note, we are out of time. So again, I wanted to thank Greg Starita, Executive Director at JP Morgan Asset Management in the educational savings relationship area, most notably 529, among other things. Thank you, Greg. We appreciate you making the time this evening.
My pleasure. Have a great night.
Thanks, Greg. Appreciate you coming on board.
Thanks for having me.
Dom and I will be back next week with a new edition of the Lebenthal Report. Have a good night, everybody.
Good night, all.
Thanks for tuning in to the Lebenthal Report. Dominic and Michael will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week. The Lebenthal Report is brought to you by Lebenthal Global Advisors, LLC, a registered investment advisor, and Lebenthal Financial Services, Incorporated, a FINRA registered broker-dealer. This podcast is for informational purposes only and should not be considered investment advice. The views expressed are subject to change based on market conditions. For more information about our qualifications and business practices, visit our website, lebenthal.com, where you'll find links to SEC's and FINRA's official resources.